What will it cost to start your business? It's hard to tell for sure, but it's important that you start planning early on to avoid any unforeseen expenses. Launching a successful business requires preparation, and while you may not know exactly what those expenses will be, you can and should begin researching and estimating what it will cost to start your business. Now, before we go into all the good things about financial projections and all the expenses that you may incur, I have something for you about our CRM.
As a small business owner, you have a lot on your mind that it can seem out of control. You've got to go through the marketing process, then react to your leads, set up meetings, sales pitches, respond to emails, texts, phone calls, social media messages, and for one, that can be exhausting. So what can you do about it? For a start, you can subscribe to the Monkeypesa Sales and Marketing Hub that would help you put all your customer correspondence in one place. Send emails and texts, set up meetings, make calls, hold video meetings, and more all in the same place. Try it today by going to dashboard.monkeypesa.com and signing up. Monkeypesa Business Simplified.
Now then, what are startup costs? Startup costs are expenses incurred before the business is running. These are the bills and expenses you will need to cover leading up to the launch of your business. While every business will need to account for specific startup costs, your business will generally fall under either a brick-and-mortar, online, or service-based organization. So why do you calculate startup costs? Like your business plan, estimating your startup costs is part of building a roadmap for your business. Having even a rough estimate can help you avoid unnecessary risks and stay on track during more volatile months. Still not convinced that you should explore your startup costs? Here are a few more reasons why you should calculate your startup expenses. Number one, every business is different. Every single industry and business requires vastly different expenses, which means there is no simple formula for calculating startup costs. But that doesn't mean you can't make an educated guess that accurately reflects the needs of your business. A software as a service business, for example, may need to account for additional online tools or server expenses to keep its site up and running. But an apparel store, brick and mortar, or online will need to account for physical inventory and shipping expenses. Number two, establish a firm foundation. Many people underestimate startup costs and start their businesses in haphazard, unplanned ways. This may work in the short term, but it is typically much more difficult to maintain. Managing startup costs is almost impossible until you calculate them accurately, and customers are often wary of brand new businesses with makeshift logistics. Next is build your financial plan. Now, your financial plan is an overview of your current business financials and estimates for growth. Having realistic startup costs, even if they're just estimates, is one of the key elements of building a viable financial plan. Understanding what it will take to start your business can help you estimate your profits, conduct a break-even analysis, extend the runway of your business, and identify potential tax deductions. To successfully leverage your financial plan, you'll need to revisit it consistently throughout the life of your business. Having these early estimates will provide you with a baseline that you can reference during these reviews. After a few months of operating, you'll know if your estimates are realistic or if you need to make any adjustments. Next is to secure loans and attract investors. Investors and lenders want to understand the roadmap you have in place for your business. You'll need to be ready to answer questions about your business model, sources of revenue, growth forecasts, and initial startup costs. They need to see that your business is viable and that you've thoroughly explored what it will take to start, operate, and grow. Having realistic startup costs laid out is a necessity in this case, and being able to show how you believe expenses will change or remain similar over time will give them a better idea of how you intend to manage your business. Now let's look at how to identify your startup expenses. Like when developing your business plan or forecasting your initial sales, it's a mixture of market research, testing, and informed guessing. It's up to you to adjust accordingly based on actual results over time. If you need a starting point, look at your competitors and industry benchmarks for specific expense for specific expense categories. You don't want to directly copy the expenses you find, but confirm if your estimates make sense based on current market factors. You may find that you have a competitive cost advantage based on a healthy vendor relationship or common expense you're able to avoid based on your business model. Now that may still leave you wondering, how do I actually estimate realistic startup costs for my business? Start by making these 3 simple lists. Number 1, startup expenses. These are expenses or upfront costs that happen before you launch and start bringing in any revenue. This should be split into one-time and ongoing expenses. By separating them in this way, you can give yourself a more accurate estimate of what it will take to launch your business. Now, here are some of the common expenses to consider in both categories. The one-time expenses include permits and licenses, incorporation fees, logo design, website design, brochure and business card printing, signage, etc. Then the ongoing expenses will include rent, payroll, taxes, legal services, loan payments, insurance payments, utilities, and marketing costs. These make up just a handful of the potential costs that you'll need to consider. Some will remain fixed, others will operate as variable costs, and some may shift between the two over time. By having them outlined this way from the start, you'll be able to keep better track of your expenses and identify any natural cost-cutting options over time. Number 2 is startup assets. Now, these are costs associated with long-term assets purchased in order to start your business. While cash in the bank is the most basic startup asset, and we'll talk about that later, there are some other common assets you may need to invest in, like starting inventory, computers or other tech equipment, office furniture, and vehicles. Now, there is a reason that you should separate costs into assets and expenses. Expenses are deductible against income, so they reduce taxable income. Assets, on the other hand, are not deductible against income. By initially separating the two, you potentially save yourself money on taxes. Additionally, by accurately accounting for expenses, you can avoid overstating your assets on the balance sheet. While typically having more assets is a better look, having assets that are useless or unfounded only bloats your books and potentially makes them inaccurate. Listing these out separately is good practice when starting a business and leads into the final piece to consider when determining your startup costs. Now, the final way to identify your startup costs is the cash requirements. Cash requirements are an estimate of how much money your startup company needs to have in its checking account when it starts. In general, your cash balance on the starting date is the money you raised as investments or loans minus the cash you spend on expenses and assets. This is the last piece of the puzzle you'll need to get started. As you build your plan, watch your cash flow projections. If your cash balance drops below 0, then you need to increase your financing or reduce expenses. So how much cash do you need? Many entrepreneurs decide they want to raise more cash than they need so they'll have money left for other contingencies. While that makes good sense when you can do it, it is difficult to explain that to investors. Outside investors don't want to give you more money than you need because it's their money. You may see experts who recommend having anywhere from 6 months to a year's worth of expenses covered with your starting cash. Now, that's a nice concept. That's nice in concept and would be great for peace of mind, but it's rarely practical. And it interferes with your estimates and dilutes their value. Now, for a better estimate of what you really need in your starting cash balance, you calculate the deficit spending you will likely incur during the early months of the business. From there, estimate how much cash you'll need moving forward until you hit a steady break-even point several months and even years after opening. So what are the things to consider when estimating startup costs? Pre-launch versus normal operations. Without definition of starting costs, the launch date is the defining point. rent and payroll expenses before launch are considered startup expenses. The same expenses after launch are considered operating or ongoing expenses. And many companies also incur some payroll expenses before launch because they need to hire people to train before launch, develop their website, stock shelves, and so forth. Now, the same defining point affects assets as well. For example, amounts in inventory purchased before launch and available at launch are included in starting assets. Inventory purchased after launch will affect cash flow and the balance sheet, but isn't considered part of that starting costs. So, be sure to accurately define the cutoff for startup costs and ongoing expenses. Again, by outlining everything within specific categories, this transition should be simple and easy to keep track of. Your launch month will likely be the start of your business fiscal year. The establishment of a standard fiscal year plays a role in your analysis. It can be convenient to establish the fiscal year as starting the same month the business launches. In this case, the startup costs and startup funding match the fiscal year, and they happen in the time before the launch and beginning of the first operational fiscal year. The pre-launch transactions are reported as a separate tax year, even if they occur in just a few months or even 1 month. So the last month of the pre-launch period is also the last month of the fiscal year. Now, consider startup financing as part of your startup costs. Of course, startup financing isn't technically part of your starting costs estimate, but in the real world, to get started, you need to estimate the starting costs and determine what startup financing will be necessary to cover them. The type of financing you pursue may alter your startup or ongoing costs in a given period, so it's important to consider this upfront. Here are common financing options to consider. Investment, what you or someone else puts into the company. Now, it ends up as a paid-in capital in the balance sheet. This is the classic concept of business investment, taking ownership in a company, risking money in the hope of gaining money later. Then we have accounts payable. Those are debts that are outstanding or need to be paid after a certain time according to your balance sheet. Generally, this means credit card debt. The number becomes the starting balance of your balance sheet. Then we also have current borrowing. Standard debt, borrowing from the banks, small business administration, or other current borrowings. Then we also have other current liabilities. Additional liabilities that don't have interest charges. This is where you put loans from founders, family members, or friends. We aren't recommending interest-free loans for financing, by the way, but when they happen, this is where they go. We also have long-term liabilities, which is long-term debt or long-term loans. Aim for long-term success with realistic startup costs. You'll have a better chance at securing loans, attracting investors, estimating profits, and understanding the cash runway of your business. The more accurately you lay out startup costs and make adjustments as you incur them, the more accurate vision you have for the immediate future of your business. Now, that's all we had for you today. If you like this video, please like and subscribe.